What's up, everyone, and welcome back. 360 in the house. And we are at the 360 Elite Traders course, another chapter. Hopefully, y'all have been enjoying these chapters. Hopefully, y'all are learning a lot. Man, we just gonna keep on going. It just keeps getting better. You're gonna keep getting better. This is the bomb right here. This chapter right here is gonna be on risk loss management, which kind of ties in to the one that you guys already had on trading psychology, is being probably two of the most vital, I am not kidding you, probably two of the most vital chapters that you're going to have literally in this course. They are so important to your ability to be successful and to do well. So let's just go ahead and get right into it. We are talking risk loss management. Look, it is literally got to be the core and the foundation of your trading system. The core and the foundation. Besides trading, the psychology skills that you learn, the risk and loss management comes first. Man, like I said last time, you can be the greatest chartist, the best at technical analysis, explain it, define it, teach it. But if you do not have an outstanding risk loss management strategy, you are going to lose. You are going to lose. I've told you before, I knew a lot of people that could read charts like nobody, but when it came to actually trading, they sucked. And it's because they just didn't have great risk loss management skills. They just didn't know what they were doing. This is more important than reading a chart. Managing your risk and handling your losses is way more important. Why? It prevents you from destroying your account, blowing your account up. If you destroy your account, you're out of the game. And, for many people, they treat it like, trading like gambling. Well, you don't want to do that. You want to play with the odds in your favor and reduce risk and reduce your losses. That's what it's all about. That's what keeps you in the game and keeps you keeps you making money and actually growing your portfolio versus destroying it because of not handling or facing your risk and losses. So very, very important. All right, let's get in some general principles. First of all, take direction that should be from the market, not form. Take direction from the market. Don't take your direction from your hopes, dreams, and fears. When it comes to establishing your risk levels, your risk tolerances, when it comes to establishing your loss prevention and your stops, when we start making those stops, it must be based on information from the market, not from your feelings, not from your hopes, your fears, your dreams. It's got to come from the market. You've got to be systematic. You want to define your risk before you get into a trade. There are two things you got to know before you enter a trade. Two, if you can guess them right now, then you're ahead of the game. The first is where you're going to set your stop, how much loss you're willing to take. The second is what your targets are. You don't just enter and go, well, let's just see how it goes. A lot of people do that. A lot of traders do that. They just, they get a hot tip, a hot tip from a friend, from a neighbor, and they get it and they're like, let's see how it goes. I mean, I'm going to tell you, I can't even tell you how many people do that. That's insanity. Before you even enter, you know where your stops are and you know where your targets are. Can you have multiple targets? Yes, of course. But you know what those are. You know where your exits are. You know where the door is. You always know where the door is. I learned that when I taught at the Security Forces Academy. When you go into any place, for security and safety reasons, one of the first things you want to look for is where the exits are, where the doors are at. In case the place starts catching on fire, you have an active shooter, something crazy happens, I want to know how to get out and get the safety. Well, that's the exact same thing with trading. That's the exact same thing. Know where you're going to cut your loss. Notice I said cut. Know where you're going to take and cut your loss. Yes, you're going to have to take and cut losses. It's part of the game. Know it. Be ready for it. Accept that that's part of trading. Face and cut them without hesitation. See, it doesn't do any good to put those in place, to have a stop, and then all of a sudden the price is coming down. You're like, man, I might get stopped out. Yeah, it might go lower than it, but I think it's going to come back. So you remove your stop. Guess what you just did? You just traded on emotion. You traded because you didn't want to take the loss. Be honest with yourself. You move the stop because you're like, I don't want to take that. It's going to come back. And then you watch that puppy just collapse and disintegrate. That's the difference between having a system or moving off of your emotions, man. Don't do it. Face and cut your losses without hesitation. Now, even though you may have put in a stop at the beginning, you have to maintain those losses. You have to, not maintain the losses. You got to maintain that loss prevention strategy, that risk management throughout the trade. Don't just stop at the entry and then the price goes up and it moves, it hits targets. Don't just leave that stop down there in the dust. Always maintain to protect your profits. Use that stop, move that stop up in a way so that you can protect those profits. So you don't want to make 25%, 25%, and then what? You're like, you didn't place a stop. And you're like, it's going to keep going higher. And then for some reason, it breaks down and it goes all the way back down. And now it's below where you initially had it in the first place. You don't want to do that. So risk and loss management does not stop at the point of entry. It carries on. That strategy has to carry on throughout the trade. Be systematic, be regular, be thorough, and be vigilant, and be constant, and be confident. Did you get all that? That's not written down, so I don't think I can repeat it. All right. Look, this is how simple it is. And I'm going to show you the secret. You're going to love it, and it's going to make mathematical sense. There are 4 possible outcomes on a trade. They are a big loss, a small gain, and a large gain. You ready? Here's the secret. If you can remove one of those, if you can remove and eliminate one of those, you can make money trading. I bet you can't guess based on this slide. Look at those red arrows where I have them split between big loss and small loss. If you can learn to eliminate never having a big loss, then watch this. This is how it mathematically works. Your small gain, if you can eliminate this, let's say we cross that out. We're not going to accept big losses. We're going to eliminate that from the equation. A small gain will cover your small losses. And guess what that leaves the large gains for? Making money. That's right. That right there is why I know traders who are very successful, even though they win on less than 50% of their trades, because they never take those big losses. They use proper risk and loss management to cut those big losses long before they ever become big losses. So they never get hit with big losses. Does that mean sometimes they're going to get stopped out of good trades and then it's going to go back up? Yeah, it's going to happen. Welcome to the market. But what about the ones that don't? They hit your stop and they just keep on going south. Well, you just protected yourself from that demolition derby, that destruction. Wiping out days, sometimes weeks of great trades. A big loss can wipe out days and weeks and even months of great trades. I've known traders that were successful 3 or 4 months and then boom, 2 bad months came. And because they didn't use risk and loss management, it wiped out their portfolio. You don't want that to happen. So look at this, 4 possible outcomes. If you can cut one of these out of the formula, then your small gains will take care of the small losses and your large gains will handle business. See, losses don't take care of themselves. Wins do. Your wins are going to take care of themselves. Your losses will not. You have to take care of them. If you aren't willing to cut and take those losses, you cannot win. But you've got to eliminate the potential for a big loss. Very, 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 very important. So how do we do that? All right, I hear you, 360 trader, but how do I eliminate the big losses? How do I stop from having that monstrosity of a loss that ruins or damages or blows up my portfolio? Well, the first thing you have to do is identify the type and structure of market that you are in. Remember, we had a chapter on this. Markets will either be trending, whether that's trending up, bullish, or trending down, bearish. Or they will be consolidating. That could be moving sideways, that could be pulling back, or that could be bouncing. Pulling back if you're in an uptrend, consolidating if you're moving sideways, and bouncing if you're in a downtrend. It could be doing one. So you have to identify the type and structure of the market first, because that's going to help you assess where placement and where you're going to put your losses based on market structure. Remember, we let the market tell us. We don't use our emotions to tell us how where to put our stops. So is it trending or consolidating? Then we have to determine the highs and the lows. And you guys have already had the chapters that teach you how to do this using trend lines and price action horizontal support and resistance. So we use support, resistance, trend lines, horizontal lines, and you can use moving averages even. And then we place initial stops beyond the structure. Notice I didn't say below. Some of you like to short the market. So if you're shorting, then you'd be putting it above the structure. If you put your stop above the structure if you're shorting. If you are going long, you want your stop to go below the structure, below those highs and lows, below those supports and resistances, or below those supports, resistance if you're shorting. And then you've got to leave a margin of error and some breathing room to stop from getting wicked out, them stop loss searching candles. And we'll look at that in just a minute. So that's how we eliminate our big losses. Identify the type and structure of the market. Draw your lines, get those trends in there, get those horizontal support and resistances, determine the highs and lows, place your initial stops beyond the structure so it has room. Give it some room to breathe. Markets go up and down. Some trades take time to work out, as you guys have already seen from our elite alert trades. I mean, that's how it works. That's how the market works. And then be patient. This process never stops. And we're actually going to get in and do some of these. This process never stops. You must actively monitor and move your stops as the market gives you more information, as price structure changes, as the market structure changes, as it moves. You must actively monitor and move your stop losses. Give it constant attention. Be systematic and update your trades. Don't be lazy. Lock in profits by moving stops. We have mental stops. Anytime I say mental stop, that usually means I'm actively watching the trade. I'm sitting in front of my screen. And so in my head, I have a mental stop. Why do I do a mental stop sometimes? Well, because the market makers can't see it. So a lot of times when you put stops in the system, they can see those and they like to do those wicking candles, which I can show you how to protect from that as well. However, if I'm actively watching, I just know, hey, right around here is where I'm going to exit this bad boy if it drops. If you can't watch, I place those stops into the system by way of a stop limit or a stop loss. So be systematic and update your trades. All right, let's get to some charts. Let's go with Cardano. So I have a chart here. You can disregard all these lines. I just want you to see some stuff here because you can see excellent market structure here. You can see really, really excellent market structure. I want you to look at this market structure here. So we have this trending. Well, this is all trending. So this is trending up. You don't even have to draw a line to see it. This is trending up. But in the midst of that market structure, you have consolidation. Look at this consolidation, a sideways movement. Beautiful. Then we have another leg. Market structure trending, market structure consolidating with some pullback. There's some pullback. Then it consolidates sideways. Then we have trending, pullback, consolidate, and kind of move sideways before it trends up again. So we're going to talk about that right now. When you place your stops, you want to initially place them in a location that invalidates the trade. So let's say I have not entered the trade yet. I'm looking to enter the trade. I want you to notice, first of all, on this guy, let's pretend that, let's draw a line here. Boom, right there. Let's draw another one. I'm putting in my supports right there. Okay. So here we have some market structure right here. We have some consolidation market structure. So if I'm playing this as a breakout, okay, let's say I'm playing this I'm going to play this consolidation point, and I want to play it as a breakout. This is the breakout point. So when I enter this, let's say I entered on this breakout candle right here, this retest, this second green candle. Let me open that up. Let's say I entered here on this one, and I entered this right here. When I initially put my stop loss in, I can put it down here below. See how I've drawn this horizontal price action level? I can put my stop way down here for to be real concerned, to give it some room. So if I entered this trade at, let's say, 10 cents, 10 or 11 cents, I could put my stop down here at 8 because it's below the structure. I've drawn this. You don't want to put it right at the line. You don't want to place your stop right at the horizontal line. Why? Because even though you've drawn that support and it really didn't go below it, it did back here when it was seeking wicks. But we have a nice solid structure right here. I'm going to give it some room. I'm going to give it some breathing room. And I'm going to put it somewhere below here. So I probably put it at about 8 cents. You can see the distance from that line. At 8 cents gives me a little bit of breathing room for this. And remember, I'm playing the breakout. So that's pretty safe. That's pretty safe. I don't have to worry about getting wicked out. This would have to reverse and come against the trade. So if it was to hit this stop, it would invalidate this trade. It would invalidate. If this thing was to come up here, come down here, and then come below here, it invalidates your trade. Your trade is gone. Why? Because you played a breakout. And when I actually get into the actual trades and show you how to set those up, you're going to understand where those levels are. But I'm showing you for the point of placing your initial stop where that would go. If I put my entry here, my initial stop would be right here below. Not at the line. Give it a little bit of room. Give it a little bit of room. And you can see what happened. Boom, nice run up. And maybe I took profits here, I don't know. But maybe I was trading this for the longer haul. If I was trading it for the longer haul and my stop was here, look, even this retest, this is a retest of support, which happens a lot. And people freak out about that. I'm like, look, a lot of times breakouts will retest the areas of support, but you were safe. You would have still been safe. This right here, look at this wick. I'm going to show you this. This right here, this was a beautiful, beautiful climb. Almost a 10-cent climb. Almost a 100% move. From about 10 cents to about 19 cents. So this was the normal pullback area, but do you see this wick? That is called a stop search wick. All these traders right here, all these traders, depending on where they get in, had put their stops all throughout here. They had stops in here. That is why this dipped all the way down there. That is why you see it happen all the time. That is why it happens all the time. I'm teaching you the underlying market conditions between buyers and sellers. This wick down because all these traders had their stops here. So once it hits one stop, it drops it. Once it hits another stop, it drops and drops and drops until every stop is taken out. So if you were in this trade for a swing, because you put your stop down here, this would not have hurt you. Remember, the people that exited here on this target, they were already fine. But if you were in this for the longer trade, let's say you were doing a longer swing trade, you would have also been okay, and this would not have panicked you. This would not have panicked you. You're going to see this again and again and again. So I pulled this chart up because we're going to now see this happen again. Watch this. We have yet another structure here. Consolidation. All right, so let's say you rode this up and you did not place your stop in yet. It wicked down. You want to give, once a market pulls back or consolidates, you don't want to instantly throw your stop in there. You want to let the market show you its hand. Because look, this, if you would have automatically moved your stop up, you would have got stopped out. You would have got stopped out here. So we let the market, look what the market does in consolidation. Do you now have tons of information based off of this? Yes, you do. You have tons of information based on this consolidation. So now you redraw that support. If you're still riding this, and you can move your stop up. That we don't have to worry about this wick. That was taking out the other stops. This is now valid. This area up here is now valid support. So I could now place my stop below here. And remember, I'm riding this gravy train. Or if you're new and you're playing the next breakout, you would still put your stop below here. It works for both. If you're still on the train, it works for you because you're using horizontal support. Or if you're just getting on, the stop is in the same spot. So riders can continue to ride this puppy because they would have placed their stop here unless they prematurely set it. If you prematurely set your stop, you would have got stopped out and you would have lost most of this gain. You would have lost most of this gain. Boom, another breakout. Yes, now you wait again. And you're going to see the same thing occur over and over. Look, again, another stop-seeking wick. So we had the move, broke through. We have resistance. It came down. All these traders had their stops lined up in here. All these traders had their stops all up in here. And they got wicked out. They got wicked out. So if you would have put your stop at any time during this time right here, and you would have put it below this line, like let's say you saw this pullback, this pullback. Okay, this is a safe spot. You would have got wicked out. Give it some time. Let the market do its thing. Boom. Now, once you see this structure beginning to build, you can now know what that candle was. All right, that was my wick candle. The signal of that long wick told you that was the stops getting wicked out. I'm going to say it again. These wick candles after strong moves. These wick candles after strong moves. These wick candles after strong moves. That is those traders that ran on that last run getting stopped out. So it tells you whatever's next, you can probably be safe to put your stop under. Which, as you see right here, we have this line right here. These two down here. So you would have moved your stop right below this line. And guess what? You get to ride it again. I mean, this person down here doing that system could have entered down here and rode this gravy train all the way up. All the way up. That is an example of using horizontal price action, support and resistance to determine your stops. Don't place it at the line. Place it below the line. Give that consolidation pullback time to develop before you move your stop up. Or you're going to get what? You're going to get wicked out. I mean, it's happened every time here. Wick, wick, wick. I mean, it happened here. Wick. I mean, those are stop sweeps. Let that play out. Then let the market show you its hand. Then move your areas of support and resistance up. And then give it some room. Don't put your stop right at the line. Put it underneath the line to give it some breathing room, some space. So that's very important. Place it in a location that invalidates the trade. If that thing was to come back down there, it invalidates the trade. So you don't want to keep holding an invalidated trade. I mean, you don't want to keep holding an invalidated trade. If the trade's invalidated, it's invalidated. All right, now let's go look at XLM because we have some trend line actions which can also help you draw areas for it can give you more information. I like to use both horizontal and trend lines. You guys already know how to draw these, so you should have both. You should literally have both on your chart when you're doing this. All right, let's go ahead and draw one here. Let's draw one here, right there. Boom. So anybody playing this off this trend line? Anybody playing this off this trend line? And we got this breakout of this horizontal area. And we have this other trend. I mean, there's a lot going on here. Nice bounce off this trend line. Coming on up. You've got a beautiful wick down candle. So you know this structure is probably sound. And you're probably not going to see that. And you have this trend line. So if you're playing this bounce here, you're going to put your stop. Give me my arrow. Right here. Because it is below the trend line and below the horizontal area. And we're not terribly concerned about this. Because that was a wick candle. And we have tons of good market structure. And we have two solid lines of support. When you can get a a trend line to match up with either a support or resistance, that means it's that much stronger. And as you can see here, this area held like a beast, like a monster. Held up just fine. That made a great bounce trade right there. And look, by placing, if you entered this off this bounce on this candle, man, you got to ride a huge train. Now, don't move. Once you get up here, don't move this yet. Because look what happens. 2, 3, 4, 5 days later, the wick candle comes. Boom. The wick. So if you would have moved your stop up to here, you would have got wicked out. Once you see this or this happens, look at the market action. You can now move this stop up in here. And as you can see, we have this other line working out. So you have a lot of beautiful things happening here. You have a wick where stops got taken out. You have market structure. You have a beautiful trend line, which if I took you back in history, you'd see where that is. And then you have this horizontal resistance. So I can put my stop literally anywhere up in here and be fine. I don't have to worry about that wick candle. Right in here and be fine based off these lines. Give it some room, give it some area. And look what happened. I got to ride the next train. And then we have, boom, that right there. Same thing happens up here. You can use your trend line, which it came down and wicked to it, and it's finding support. And continue to move your stop up below the trend line. Up below the trend line. And you can continue to look at your horizontal areas and your trend lines to make those type of decisions. But we got good feedback right here. We are milking this the whole way. Milking this trend line the whole way. And we're also milking, in a combination, these horizontal areas of support and resistance to determine where to move those stops to keep us in the game, but protect us from the trade invalidating. If this is to break this down, if this area up here was to break this down and start heading this way, it could invalidate the trade. It could invalidate the trade. So make sure you watch out for those, give time for those stopgap candles. They're called stop seeking candles. Give time for that to show its hand. Then you can have some structure to work off of. You can have some market to work off of and have a better idea of where to put those stops. Use your trend lines, use your horizontal support and resistance, and give it a little bit of room below those to set those. When the market runs, let it show its hand on that pullback consolidation. Let it show its hand. Draw your trend lines, draw your horizontal support resistance. Look for that stop seek candle. It doesn't always show up, but look for it. Look for it. Don't be impatient and rush to set that stop, because 9 times out of 10, if you just set it immediately after the run, you're probably going to get wicked out. You're probably going to get stopped out. All right, that's pretty much it for this. We're going to get into that a lot because when I actually go into each individual trade, I'm going to have a video for each one of my trade setups. You're going to get to see where the stop goes for that. But I wanted you to kind of get an overall class, an overall picture, so you have an understanding, because you guys are actively using the email alert trade. So I wanted you to know a little bit better how to do this. So that's it for this course, this chapter. I hope it made sense. Watch it again and again and again. Until next time, here comes the boom.